Hampton Roads, and welcome to this week's edition of Beyond Wall Street, the show that helps take the mystery out of Wall Street and helps it make sense for you on your street. I'm your host, Kristen Oakley, and joining me in the studio, we have Kenny Porter. He is the president and founder of Kenneth Porter and Company, based right here in the Hampton Roads area, and Wesley Gomez, who is the chief investment officer. Kenny, Wesley, it's great to be in the studio with you. How are you this week?
It's good to be back.
It's always fun to be on set with you.
Oh, it's a lot of fun. We've been laughing really hard already, and we're just getting started. So we're excited to bring you into the conversation today. The title of today's show is Risk On or Risk Off. The reality is that our risk tolerance often needs to change as we enter and near and approach retirement. And actually, there's a difference between one's risk tolerance and one's risk capacity. Do you even know what yours is? So that's what we're going to be diving into today. And to start off, I know that when folks come in to meet with you for the first time, you ask a wealth of questions.
Yeah.
And obviously, the more information you can gather from someone, the more you're going to be able to help them and really develop a custom tailored, personalized retirement plan for them. So I'd love to start off on this conversation of risk. What are the questions that you ask? How does this conversation go so that you can accurately assess what someone's risk tolerance actually is?
So I think early in your comments, you talked about capacity. And the way I would like to describe that is your emotion. Because most people, when it comes to risk tolerance or even just financial decisions that they make in general, most of us as human beings lead with emotion. And then we go back later to try to resolve that emotion with our logic. What risk assessments and what in Wes's performance in our wealth advisory firm is really focusing on that risk in a way that we put logic ahead of emotion. And then we can be very logical in our questions to understand the emotion that someone brings to the table about their money. So it's the who, the what, the when, the where, the why. And that's going to reverse engineer into a risk score. Everybody has a number. And so Wes is going to take that. If you want to add to that, Wes?
Yeah, so you think about the journey that you're on, right? The path that you want to get to. Let's say you're just in that retirement phase. How long will this money last, right? What is that roadmap? What is the path you should take? And what we use is something called Riskalyze. And what that does is it actually asks you a few questions, right? What are these dollars for, right? And then so that allows us to reverse engineer to see how those assets, how much risk those assets should take. And think about a speed limit, right? 55, 65, depending where you live, that's a speed limit. But using Riskalyze, number one is cash, right? Very safe. 99 is Bitcoin. All right.
Right.
So our technology, it uses some AI in the backdrop. It allows us to see where is your current assets, all those accounts aggregated all together, and give you a score. Now, for reference point, the broad market, the S&P 500, that's going to be around 76.
Okay.
So if you're above 76, your total assets are going to be above the broad market. Maybe that makes sense for your current situation. Maybe it doesn't, right? If it's underneath that, maybe you're not taking enough risk to get to your goal.
And so during that phase, you can afford the opportunity to take more risk in the markets. You can be more heavily based in what we refer to as equities, stocks and mutual funds that are in publicly traded companies. But when you take that position now, that 5-year window of right before retirement or 5 years right into retirement, now we enter what we refer to in our industry as the distribution phase. And in the distribution phase, now we're going to add another variable to your risk. And that is the risk of how much money you need or how much cash flow you need each month.
Right,
and
that
I
you
always
need to be generating for yourself from those distributions that you're making.
That's right. So that need reverse engineered. So if we think out into the future, what is your preconceived idea of how much money you need in your distribution phase? That will help us reverse engineer how much risk we can take in the accumulation phase, the pre-distribution phase, that 5 years leading up to retirement, and then ultimately when we start taking those streams of income. And everybody's number is going to be different.
Right.
So it requires us to build a customized portfolio for each and every individual.
And I love that the name of the software is Riskalyze, right? It's kind of combining risk and analyze, therefore analyzing your risk tolerance. So that number, though, Wesley, that 76, you gave the example, right? Is that someone's risk tolerance, and then you also have to determine their risk capacity, or does that combine the two? How are we defining those two
Well,
things?
that's right. There's two components, right? What is their current risk score of their assets?
What they're currently invested
exactly.
in, right?
But then how comfortable is the client taking risk?
And that's the capacity
And
part.
that's where there could be a disconnect, and 9 times out of 10 there is. And whether you work with us or not, adjustments you typically have to be made.
Yeah, I think I already know the answer to this just from my work in the industry, but how often is it that folks come in and there is that misalignment where they have no idea, they thought they were invested conservatively, and all of a sudden you run the reports and they realize it was the complete opposite?
Well, I think retirees are hearing this message from a multitude of advisors today. So I think it's starting to resonate with consumers, because what we're finding is that retirees come in and go, hey, I really had a handle on the accumulation phase. I did a lot of it myself, but now I know there's a different game. And if we think about it like mountain and rock climbing, going up the mountain we refer to as the accumulation phase.
Right.
Coming down the mountain we refer to as the distribution phase. So when you're going up the mountain, most people had this preconceived idea is that going up the mountain, I've achieved all my goals, I've staked the flag, I'm at retirement. But what's interesting, Kristen, is that as you take your journey down the mountain, that roadmap can be a little different.
Yes.
And we've talked about this on the show before, that 70% of mountain and rock climbing accidents happen on the way down.
On the descent.
On the descent. And what we want to do is take out that risk of the descent and make sure that you have enough rope to live out your journey and preserve the wealth over your lifetime.
Right.
And so that's going to require that we understand the different risk score and risk capacity. Your desire, your emotion that comes into that is a super important conversation that needs to be had and often reviewed.
Yes.
It's not just set it and forget it.
Yep.
Because your emotion, your life, changes come in retirement.
Well, if someone's watching today and going, you know what, that might be me. I'm not sure how I'm invested. I don't know what my risk tolerance and risk capacity is, and if there is an alignment or not. What would you say to that individual who's watching?
You know what I think you would hear from us is take an opportunity to get a second opinion. Take an opportunity to get a complimentary review where we can take a look at your risk capacity, your risk score. We can give you your own customized number to understand where you're at as a comparison to the market. And we do that inside a complimentary review. You can leave your checkbook at home. We're not going to bill you. We're not going to charge you anything to have this conversation and have this second opinion review of your current assets and your current risk.
Well, Kenny, Wesley, thank you so much. I know we have so much more to talk about on this important subject, but again, if you would like to receive your complimentary strategy review from Kenny and Wesley and the team at Kenneth Porter & Company, it's really easy. All you need to do is just pick up the phone and call this number on the bottom of your screen, 844-575-8071. You're also welcome to take out your smartphone, and you can just open up that camera app, point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary strategy review that way as well. More on today's episode of Beyond Wall Street right after this.
So our philosophy is to really help the client understand how to navigate from a position of where they are to where they really want to be. Most financial planning, I think, focuses on the needs aspect. We like to approach financial planning from the point of view of wants planning. What do you want from your retirement? And if we can work towards wants goals versus needs goals, we believe you're going to be much happier and much more successful in your distribution phase by focusing on the want versus the need. We pride ourselves on giving our clients our personal cell numbers and being able to be on speed dial if they need me. They know they can get me personally still. They also know that they have the confidence in my team because they've been so well trained, a team of certified financial professionals and financial analysts that can help our clients buckets with planning strategies. So our clients typically are coming to us in that pre-retirement or retirement phase. So they've already either done a good job with their current advisor through the accumulation phase, or a lot of our clients started out as do-it-yourselfers. And they knew that getting to the distribution phase, that there's far more complex issues to deal with. And so they want to come to an expert to get help with how do you take distributions appropriately. I would say that most of our clients are coming to us out of a need and a desire to try to improve their retirement distribution phase.
Hello, Hampton Roads, and welcome back to Beyond Wall Street. I'm your host, Kristen Oakley, here with Kenny Porter and Wesley Gomez from Kenneth Porter and Company. We are talking today all about risk and how important it is to understand your risk tolerance, and even more importantly, your capacity for risk and how that might need to shift and change as you near and enter retirement. And so I know that what we're kind of doing today is helping folks understand what the conversation looks like when they come in and meet with you all for the first time, and you are digging deeper into assessing someone's risk tolerance. I know, Kenny, that you all engage in a different approach when it comes to helping folks understand how their money needs to be allocated. You call it the bucket approach. So I'm excited to hear more about that.
Yeah, we like to just think of things in that KISS principle, keep it simple, silly. And so, using some things that when a husband and wife or partners go home and they're talking about our last conversation, having those things that they can recall. Oh, Kenny talked about the buckets, and Wes talked about money in these separate buckets. So we really just, at a very simple, high level, we separate into 3 buckets.
And that visual is very powerful, right?
That's right. And we will draw it on our Zoom calls or on our Blackboard within our office. But we think of buckets in liquidity, protected income, and then growth. So we have a growth bucket, and that growth bucket, it should be designed that we can leave those assets alone and give them 20 plus years of accumulation in the distribution phase. So if we leave assets alone and long enough, markets will decline, markets will go up.
Right. They only do one of 2 things, right?
That's right.
They go up and down. That's what they do.
So we just need the time for that to recover without the disruption of distributions. So then Wes and I will re-engineer where you're at in your planning to understand the protected income piece. That's money that we cannot take significant risk with. So we want that risk score to go down. Maybe the growth bucket can have a risk score of 76, like the S&P 500. Because we have time for that money to accumulate.
Right.
But in that secondary bucket, the protected income bucket, that's going to provide the cash flow, the income, and the safe income, safe from market volatility. And people will always go to, well, you must be talking about an annuity. That is just a product in the overall process.
It's one of the tools available.
That's right. And is it appropriate for you? That depends, again, on your risk, your risk tolerance, and then what's suitable is what the industry would say.
Right.
And then that liquid bucket really has to do with cash equivalents. Readily available, I can get to it within 2 days. It's there in my bank account. It's not exposed to providing the income for me. It's not exposed to the market gyrations. And so having those 3 buckets in place gives our clients a very simple look at how those cash flows and growth will work in the distribution phase.
Yep.
So when you are assessing this bucket approach with people, obviously it seems like money has its different jobs that it needs to
Purpose
do,
money.
right?
Yeah.
So how do you go about determining how much needs to be in any one of these buckets?
Well, I think Kenny mentioned before that our average client was around early 60, 62.
Yep, 63.
And one of the questions we always like to ask just to see, how did you feel about those losses you may have had during the dot-com crash or the housing crisis, right? And how do you feel today if that would happen to your assets, right? So they had that feeling in the past.
Right.
You don't want to feel that now. So there's that emotional tie. So what approaches, what strategies are there to maybe reduce or mitigate that risk from happening again? And I really think that's where that bucket strategy comes into play, because most of the clients, it's a new approach, right? But again, there's no cookie cutter approaches.
Right.
There's that talk annuities are not for everyone. Yes, I agree. But are they for the right situation? Definitely.
And so that allocation question that you asked is how much goes into the protected bucket versus the growth bucket. I think the easy answer is, well, how much cash flow, Kristen, would you need? And if you had a 20% loss in the market or a 50% loss in the market, how would you react to that if that happened? And we ask our clients who have probably experienced this in that 2000 to 2009 decade. In the industry, we refer to that as the lost decade.
Right. Yep.
So the dot-com bubble burst, the housing crisis of 2008. How did you behave when those markets corrected during that period? And maybe you were in the accumulation phase, so you didn't change your game.
Right, because time was on your side at that point if you still had many more years in the workforce.
That's right. But I saw a lot of people during that period actually react by selling off, by getting out at a low. So if we build out a plan and a strategy for a consumer or one of our clients to be able to have the permission to stay fully invested, that's powerful. And they get the opportunity to stay fully invested when the markets are gyrating, when they're underperforming, because we've got the most important part of the distribution phase, cash flow.
Right.
Making sure your after-tax dollars adjusted for inflation. You've seen inflation be brutal over the last 2 years.
Yep.
So adjusting for inflation, adjusting for taxes, your nominal yield, that would then give us the idea of how much we need to have in that protected bucket.
Right.
For some, it might be 70%. For others, it may only be 30%. It really depends on the individual, and that's where not having a cookie cutter approach, but having a customized strategy and plan in place.
Really makes a difference. And I'm curious, this question, I would assume when you ask someone, how would you feel if you lost 20% of your portfolio? That elicits one emotion. What happens when you take, instead of a percentage, you give it a monetary amount?
Yeah.
Oh,
Talk about that.
That weighs heavier. So let's say, for example, someone had $1 million portfolio, markets go down 20%. How do you feel? 20%, well, it might generate a little bit of emotion, but you hear 200,000. That's a heavy word.
That makes it a lot more real.
Yes, yes, that's tangible, something you can think about.
For sure, especially if that's money that you are now having to start off retirement with $200,000 less than you had accumulated, and now you have to make that money last you even longer, right?
Exactly, and some simple math, if you lose 20% right in the market, you need a 25% return just to break even.
Yes.
How long will it take you to get 25% returns on the markets? That could take some time. During the dot-com crash, housing crisis, a 50% loss requires a 100% return to get back to even. And the people we're working with, they don't have that time to get even.
No.
And if you take the situation of the S&P 500 as an example, and we go from 2000 to 2009, looking at the S&P 500, including reinvestment of dividends, the stock market during that period, the S&P 500 during that period, did right under 1% negative losses each and every year, on average. But if you take 2009 to 2019, the S&P 500 did well over 13%, including dividends being reinvested.
Right.
But when you look at the 20-year scope of that, the average was 6.06% over that 20-year period. So giving the opportunity for markets to recover is the name of the game. And that name means you have to take a position in protected income so that you can have the opportunities of exponential growth in your portfolio.
Well, the big critical thing too is people can't always determine. Well, of course, we don't know what the markets are going to do, right? So we don't have a crystal ball. We just know they go up and they go down. But it's the timing of when you are retiring that can be so detrimental. It's something that we talk about in this industry known as sequence of returns risk. So talk a little bit about what that is, because that's what we're hitting on, but I want to really help folks understand this is why you have to be paying attention to these things.
Yeah, it's a great point, Kristen, that when you look at sequence of returns risk, you could have two portfolios that over a 20-year period average the same rate of return.
Right.
And let's just say that average return was 8%. The difference is that when you go from the accumulation phase into the distribution phase, and now you add that next variable of income being taken from the portfolio, if you start out in the distribution phase with negative returns, let's say we go back to 2000 to 2003, the dot-com bubble burst.
Right.
3 years of negative returns. If you retired during that period, you had a high probability of running out of money, even with the market having 10+% returns 2009 to 2020 or 2019. That sequence of when you started taking distributions
Right.
to the sequence of negative returns, followed by a negative return, followed by a negative return, can lead to portfolios
Eroding that much faster.
eroding.
Yeah.
Exactly right.
Yep.
So giving yourself the opportunity to not have that happen means that you've got to make change. And when you use the C word,
Right.
change, that's what most people have to get comfortable with. That's the emotion. That's the emotion of the risk score, the risk capacity. It's change will occur. Change is coming
Yep.
if you're entering the distribution phase.
Right. Right.
So being able to plan and have a all-weather plan, which we'll talk about in our next segment, but having that opportunity to mitigate risk while maximizing the opportunity for return, that's how we minimize risk and maximize the reward.
Right, and that's, I know, what so many people want. So if you're out there watching and you're going, yes, I want to be able to minimize my risk and maximize my return, and you don't know where you stand, or you want a second opinion on what you're currently invested in and knowing, are there shifts and changes you can be making in order to achieve more retirement success, we encourage you to take advantage of the opportunity to receive your very own complimentary strategy review. Simply dial 844-575-8071, or again, you're welcome to scan that QR code down in the bottom right-hand corner, and that will get you connected as well. More with Kenny and Wesley right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Beyond Wall Street. I'm your host, Kristen Oakley, here with Kenny Porter and Wesley Gomez from Kenneth Porter & Company, based right here in the Hampton Roads area. We've been talking today about the importance of understanding your risk tolerance, your risk capacity, and how that needs to shift and change as you are entering your retirement years. And you know, we've shared some figures and numbers and percentages, and we've talked about sequence of returns, risk, and all this stuff, but we all know that personal finance is really more personal than it is finance and numbers. And really the reason and why it's so important to have these conversations is folks have dreams, they have goals for their retirement. That's what this is really about.
Yeah.
You're in the business of helping people figure out what they can do, not what you can't do in retirement. So I'm curious, you know, I'm sure people out there are going, yes, I would love to be able to come in and have you review things, but at the end of the day, let's translate into what this can actually mean for someone and what they can actually achieve as a result.
Yeah, and I think Kenny hit the nail on the head earlier. It's KISS, right?
That's right.
Keep it simple, silly.
Right.
So, you know, what are the goals you have, right? What do you want to do with those dollars? Is it donate to church, charity, pay for college for your grandkids? Those are the tangible things that we want to help you achieve. The hard work, everything that we kind of talked over the last almost half hour, that's why you hire us, right? Let us do the hard work, create that roadmap, and in the end, we need to reverse engineer from the goals you just stated and go backwards, right? And I think that's where our technology comes into play, our experience here.
The needle moves for every person in life, whether it's us sitting here around this round table having a conversation or dealing with our clients' wants and needs. I believe that more people will move, their needle moves, when they can really define a want.
Yeah.
So I call it wants retirement. What do you want out of your retirement? What do you want out of your income? And so defining that, the more granular we can get in those questions with our clients and us understanding that, we become an advocate for them.
Right.
And we now are in a position where it's not just, the fancy word of doing what's in their best interest. We now are pulled into their universe of what it is they want.
Right.
And we want to help them achieve that. Because that feels really good for us as an advisor. It feels great to see a person get from where they are financially to the position of where they want to be. And seeing that happen day in and day out is truly rewarding to me, my firm, my staff, because we live this stuff every day.
Yeah.
Right. Right.
And so it's important to understand the emotion that you have and the desires that you have, and figuring out how we can get you to a point where you can, have a boring portfolio, but an exciting retirement. And boring doesn't mean bad returns.
Right. It just
Boring
means you're not
means
on the roller coaster anymore,
that's
right?
exactly right.
And I'm sure what it's awesome is that you help give themselves permission to dream again once they see that it's possible, right? If you're not living in that fear of, am I going to outlive my money? Well, then that opens up so many more opportunities for those wants that you have in retirement.
Absolutely. Absolutely.
Well, good.
And I think it's really important that as we're leaving today, the thought is, how do we get you to a point from where you are to where you want to be in your retirement distribution phase?
Absolutely. Well, good. Well, Wesley and Kenny, always a joy to be with you, and thank you for this valuable information. For you at home, we appreciate you joining us. Thank you so much. And again, to get your complimentary strategy review, that number is there for you on the bottom of your screen, 844-575-8071. We appreciate you, and we look forward to being back with you next week. Thanks for watching.